Welcome back to The Real Accountant. Today, let's explore the world of bad and doubtful debts and see how they might not really be such a bad thing. We know that bad debts don't look good for a company. So why would we make credit sales to customers when there's always the risk that they won't be able to pay us back? Well, the key to any business is making sales. If we always made customers pay cash as they use a good or service, we might run into some problems. A good example here is mobile phone companies. Rather than making customers pay as they make phone calls or send text messages, phone companies usually offer the option for prepaid or postpaid phone plans. These postpaid plans are actually an example of credit sales, as the customer pays for the phone service after they've used it. This is often a more attractive option for the customer and allows the business to generate more sales. Most businesses accept that when they make credit sales, a portion of their customers will never pay the money they owe and become a bad debt. The key is to make sure the number of bad debts is small, so that the benefit of offering credit sales outweighs the costs of incurring bad debts. This is a key area of risk management for many businesses. Let's think about the kinds of decisions we might need to make as an accountant for a phone company to manage this risk. When a new customer wants to sign up to a phone plan, we would need to consider how likely they are to end up a bad debt. We might consider factors like their previous history with us, how much they are likely to use their phone, or their level of income to determine if they are likely to be able to pay their bills as they fall due. Companies often automate this process by feeding this information into a computerized credit check system, which can tell us how risky a customer is. We then need to decide if we are comfortable with this level of risk and whether or not we should take on the customer. An accountant might consider the risk the company already faces from existing customers and what kind of impact there might be on company performance if the new customer were to become a bad debt. To encourage our customers to pay on time, we might offer incentives like early payment discounts or send reminder notices to customers as their debts fall due. Effectively managing the debts of a company is just another of the tough and complex tasks accountants face. The world of bad debts becomes even more complex when we consider the impacts of COVID-19. With economies shutting down all over the world, businesses in virtually all sectors have seen huge increases in rates of bad debts. Every day, businesses like retailers and construction companies suddenly have to recognise large allowances for doubtful debts and prepare to write off bad debts. But the damage to the economy doesn't stop there, because we know that businesses in our economies rely on each other. If our retail and construction firms have large bad debts, they will likely run into cash flow issues. Suddenly, they may not be able to pay the debts they owe to their wholesalers or telecommunications or energy providers, who then might have to recognise bad debts themselves. Australian company Origin Energy has recently been forced to write off as much as $1.25 billion in bad debts. The impacts of the COVID shutdown can quickly spiral out of control and start to impact even the biggest businesses, like in the banking sector. In the last couple of months, large global banker HSBC has recognised an allowance for doubtful debts of almost $16 billion, anticipating that a large number of the businesses and individuals they loan money to will become bad debts. As more companies start to experience the economic impacts of COVID-19, we will only continue to see more and more bad debts being recognised. Accountants have the tough job of trying to guide companies through these difficult times to ensure they can survive the COVID crisis. Bad and doubtful debts are a very real and complex area, but they are somewhat of a necessary evil to allow companies to make credit sales. It's your job as an accountant in the real world to decide how to manage the risk of bad debts and ensure a business can be profitable. Thanks for joining us today. Like and subscribe for more real world content, and we'll see you next time.